The 18-year cycle, is it just a coincidence? Is it merely feudal superstition? The timing is the same every time. Can you really ignore it? The truth is, it's not that you don't believe it. It's that every time, everyone forgets what happened 18 years ago. What do I mean? Take the 1972 US recession as example. Many claimed it was the oil crisis that caused the American economy to collapse. But if you dig deeper, you'll find that the US housing market had already collapsed even earlier. Then, 18 years later, in 1990, many said the economic collapse was due to the dissolution of the Soviet Union. The US had no competition, so people stopped working, and it caused the economic collapse. But if you look closer, the US housing market had also already collapsed before that. Another 18 years passed, bringing us to the 2008 financial crisis. Once again, many attributed the US economic collapse to the Lehman Brothers bankruptcy, but similarly, the Lehman collapse was only an effect, not the cause. The real reason was actually still the Americans couldn't afford their mortgages, and the housing market has already crashed. In other words, the first domino to fall every time is always the housing market collapse. That is the fuse that ignites the broader economic meltdown. Then, unconsciously, we are now approaching the 18-year mark since 2008. By next year, 2026, this 18-year cycle is poised to strike again. Do you still remember the painful lessons of 18 years ago? 18 years ago, you regretted not buying up the assets that were being sold for dirt cheap at the bottom. Will you regret it again this time? Hello everyone, I'm Money Zen. If you think I'm fear-mongering, then why are you still watching? Since you've watched this far, you must realize that a number even more terrifying than 2008 has already emerged in the US. You must acknowledge this figure and prepare for everything. No exaggeration. If you still lack financial quotient now, you will lose your home and everything you've struggled for over the years. You'll notice that the world is frighteningly quiet right now. Absolutely no one is recognizing the current default rate for US commercial real estate, which is office buildings, retail spaces, is no longer 5% or even 8%. It has already reached 11.8%. If you look back, even after 2008, this red line only spiked up to a maximum of 11% in 2012. Yet, here in 2025, it has surged to nearly 11.8%. Why? This leads us to an even more alarming figure. The US office vacancy rate has skyrocketed to 20.7%. In megacities like San Francisco and New York, the CBD office vacancy rate is a direct and shocking 40%. Why is this happening? Since the pandemic in 2020, the US has embraced the remote work. Businessmen discovered that many meetings don't need a dedicated space, and a lot of work doesn't require everyone to be packed together. So, why pay for so many expensive offices? You could also argue that the rise of AI has replaced many jobs. Or you could say, the US employment data is worsening, leading to more unemployment. Thus, less office space is needed. This means the issue is not just that the economy is poor, so the rent is unaffordable, but it's permanent. No more offices needed. Whatever the reason is, it no longer matters. What matters is the vacancy rate data. When these offices have no tenants, how can landlords pay their mortgages? No rent means their cash flow is cut off, even if they are lucky enough to rent them out. The rental prices have already collapsed. As we know, rents are determined by market supply and demand. If everyone is scrambling to rent, office rents will go up, right? But like now, people don't even want the space if it's offered for free. Landlords must continuously lower the rent. One landlord slashes the rent, then a second one does. In the end, even with drastically low rents, it can't rent it out because everyone thinks, if I rent your office now, the next landlord will offer an even better deal. So think about this. The amount of money these landlords owe on their mortgages cannot be reduced by a single penny. Yet, the rent they collect might be cut in half. Normally, you collect $1 million in rent and owe $1 million in mortgage payments. After 5 or 10 years, you pay off the loan. All the rent you collect is yours. But now, the 100 million rent, you might only collect the 500,000 back, while still owing the bank 1 million. And that 500,000 isn't even guaranteed. This means every day you wake up, you are losing money. What can you do? First, use your personal savings to grit your teeth and pay the loan. Second is beg the bank for forbearance, allowing you to pay slowly. The final option is throw the key back to the bank and say, I don't want this property anymore. Take it if you want. Simply put, it's basically defaulting the debt. This is why more and more people are choosing this path, causing the default rate to surge constantly. And once banks can't recoup the money they lent out, what happens? They will fail. This is the history cycle. Inevitable, irreversible. The beginning of the economic dominoes collapse. But here's the question. The high default rate has been going on for a while. If we look again, the default rate started soaring in 2023. Why hasn't the collapse happened yet? This is the terrifying nature of the 18-year cycle. The bills come due. It's only a matter of time. The high default rate is just telling us the bomb is ready. But to light the fuse, we must wait until 2026. Why? Because the Federal Reserve is preparing to stop quantitative tightening. What does this mean? Stopping QT means they will stop draining money from the market. Isn't that a good thing? Every single time, we know they're lying. They know they are lying. They also know that we know they are lying. And we know that they know that we know they are lying. Yet, they are still lying. And some people, despite knowing they are lying, choose to believe their lie. That is foolishness. If you don't want to be a victim this time, and even wants to climb to a higher class, then you could subscribe to my channel. Because I'm gonna be giving you more information like this. And if you're worried, you'll forget everything after hearing it, and you don't want to waste your time. You can like this video, and it will be automatically saved in your playlist, so you can come back and follow it anytime. First, the commercial real estate of the US. No matter the prices or rents have already collapsed, it's a fact. JP Morgan states that the US office building prices have been falling for 3 years in a row. An office building worth $1 million 3 years ago might now be worth only $600,000. And it's not over yet. They predict prices will fall another 40% in the next 2 years. The most important is, back in 2020, if you borrow money to buy an office, the interest rate was only 2 to 3%. Now, interest rates have soared to 6 to 7%. So you buy an office, its price has dropped, and you can't sell it out. Its rent has fallen, and you can't lease it out for a good price. And the bank's interest is getting much more expensive. Then here's a question. Why hasn't the US faced a financial crisis yet? The reason is that these landlords borrow money at fixed interest rates. What does that mean? Say you bought a commercial building in 2020. The bank signed a contract with you, locking the interest rate. You will pay me 2% interest annually for 5 years. For those 5 years, no matter what happens outside, even if interest rates climb to 10% or 20%, it doesn't affect you. You will always pay at that 2% rate every month. That's a fixed rate. This means the cost of repayment for landlords who bought offices during the pandemic in 2020 was frozen the moment they signed the contract. So what happened in the 2020 to 2021 pandemic? To rescue the pandemic economy, the Fed lowered the interest rates to near 0% and printed money frantically. The market was flooded with cash, causing office prices to skyrocket. Countless people rushed to sign loans with 5 to 7 year terms at rates of 2 to 3%, which is nearly free. So even though property prices are down 40% and the rents are cut in half now, it's fine. They can tough it out and still barely afford that 2 to 3% interest. Even if the new market rate has surged to 6 to 7%, it doesn't matter, as their contracts with the bank are locked at 2 to 3%. Put it more simply, because of their low locked-in interest rate, their defensibility is strong. It was like being under anesthesia. Even if they got trapped, as long as they didn't sell and kept paying, they could ride out the slump and stage a comeback. But here's the problem. All anesthesia has an expiration date. Office buildings are different from ordinary people's house. Our mortgage can be stretched out over 30 years, but office buildings' loan terms are short, typically 5 to 10 years. Most of them are 5 years. This means the fixed rate loans they signed in 2020 to 2021 are going to mature in mass between 2025 and 2027. with a majority concentration maturing in 2026. So the previous figures were not that bad actually. But the next one is far more terrifying than any other. No matter Morgan Stanley or S&P point to the same number, in the next 2 years, at least $1.5 trillion in commercial real estate debt is going to mature. What does maturity mean? You borrowed $1 million in 2021 for 5 years. You only paid 2 to 3% interest, so it's affordable to you. But after 5 years, you have to repay not just the interest, but the 1 million principal the bank lent you. How do you get that 1 million? Your office building's price has collapsed. You can't sell it. In most cases, the landlord who buy the office building, they won't have 1 million in cash to pay to the bank after 5 years. Their solution is refinancing. Simply put, they borrow $1 million in new debt from another bank to pay off the 1 million in old debt. And this is exactly why the 18-year nightmare cycle will begin in 2026. As I just said, the interest rate is no longer the 2 to 3% of 2020 to 2021, but doubled to 6 to 7%, even higher. Moreover, your office building's price has been halved. It used to be worth 1 million, so the bank lent you 1 million. Now it's only worth 600,000. So the bank might only be willing to lend you 400,000 to 500,000. This means you face not only doubled interest rates, but also a loan of only 400,000 to 500,000, which is insufficient to repay your original 1 million debt. Then think about it. Loan maturities only just started concentrating in 2025 now. Yet the defaulting landlords who refuse to pay is already higher than in 2008. The defaulting rate is close to 12%. What about next year, 2026? When thousands upon thousands of landlords choose to throw the keys back at the banks will transform from lenders into America's biggest second-hand property liquidators and most unfortunate landlords. These office buildings and retail spaces were defaulted because no one wanted to rent them. You can't sell it either, because selling large quantities would crash the price further and no one would buy. Yet the bank must keep spending money on these buildings, maintenance fees, repairs, and the property taxes. None of it is avoidable. Every day, the bank quietly loses money. So you can see that the US banks are now doing two things. First, they are scared to lend the money. In the past, if you applied for a loan to buy a car, renovate a house, or expand a small shop, banks would welcome you with a smile. But now, their first thought upon seeing any loan application is this person the next defaulter? To avoid mistakes, banks are raising their lending standards. That caused the market shortage of cash and chasing debt frantically. Because when banks are short on cash, they will flip through their ledgers, calling and emailing everyone who ever borrowed money, telling them to repay the debt. They will try every possible way to pull every single cent they lent out back into their vault as quickly as possible. This is why we've discussed in the previous videos that US banks are already shutting down. Their emergency funds are depleted. The Fed's overnight reverse repo and bank reserve requirements are hitting the bottom and touching the red line. Then, small and medium-sized companies, which rely on bank loans to survive, bye-bye. They will collapse overnight. They and their employees will be the first wave of the unemployed. Consider this. What does an average 20% vacancy rate and 40% in big cities represent? How many people does one office building support? Cleaners, security guards, baristas, convenience stores, construction workers, renovation firms, designers, and material suppliers. All will lose their jobs. In the end, even civil servants might lose their job. The US government is having massive layoffs, right? Why? Because commercial property values have collapsed. One of the most important tax revenue streams, property tax, has collapsed. Follow along? The government is constantly complaining about being broke and cutting expenses. So those non-emergency services will face job cuts, right? This is not just theory, it's already happening in reality. The Americans' most critical non-farm payroll data has collapsed. The unemployment rate is continuously surging. This will spread like a plague. Job loss means no money. No money means no spending. No spending means businesses don't earn money. Businesses that don't earn money go bankrupt. One company failure means 100 people lose their jobs. forming a vicious cycle. So, what does US job loss, commercial property collapse, and bank failure have to do with me? First, I don't work in the US. Second, I don't have savings there. Third, I didn't buy any US office buildings. If you think this way, it just proves that humans really forget everything that happened 18 years ago. Before the 2008 financial crisis, countless people thought the same thing. They believed the subprime mortgage crisis was just a matter of poor Americans speculating on housing and had nothing to do with them. What was the result? Ordinary people in Tokyo, Hong Kong, Seoul, Berlin, and Taipei, they did absolutely nothing wrong. They didn't even make any investments. But when the economy crashed, their bosses, family, and friends were forced to sell off all their companies, stocks, and houses at bargain prices. As a result, many diligent people lost their jobs too. Wasn't that true? And then what? The Fed printed money, which all went into Wall Street's pockets. Global prices soared. Salaries stagnated for a decade. Yet, the property prices rose multiple times. Wasn't that true? The question is, if you had held a large amount of cash back then and could have bought up assets frantically at the bottom, would your financial standing today be completely different? So, is this truly irrelevant to you? When these data and circumstances are already unfolding in reality, is it really that far from you? After hearing all this, you might be thinking, hold on, money then. You've been talking for a while. But isn't the Fed already cutting interest rates? And stop QT? If interest rates fall next year, won't the cost for these landlords to borrow new debt to pay off old debt decreases? Won't the crisis be solved or at least postponed? Everyone, here's the crucial point. What interest rate is the Fed actually cutting? It's the overnight rate that banks charge each other for borrowing. You can think of it as lending to you in a short term, but the interest must be repaid in a few months. But commercial property landlords are not borrowing overnight money, not short-term money as well. They are borrowing long-term, life-saving money for 5, 7, or 10 years. What determines the cost of this long-term money besides the rate controlled by the Fed? More importantly, it's market, supply, and demand. Basically, it depends on the number of people borrowing money in the market. The more people borrow money, the more expensive the interest rate. And the demand in the market, the more money lent, the cheaper the interest. Let's look at demand first. How many people are borrowing right now? The chart here shows 3 lines representing the change in demand for commercial real estate loans. It's simple. When these red, blue, and yellow lines go up, it means the demand for borrowing for office buildings is bigger. The lines going down means demand is smaller. You can see that after 2023, when the default rate started rising, these 3 lines have been continuously rising, which means the more and more people need to borrow money in the market. This is why commercial real estate interest rates have already jumped to the 6 to 7% we mentioned. As I just said, countless landlords who borrowed in 2020 to 2021 are getting trapped now. They are concentrated, ready for repaying. So they must borrow new debt to pay off the old debt, causing an explosion in borrowing demand. And in 2026, even more old debt will mature. More landlords need to borrow new debt to repay. Can we conclude that the demand for borrowing will be even greater? Therefore, won't the interest rate be even higher than the current 6 to 7%? Now, let's look at supply. Is the amount of money in the market more or less? As I just said, banks themselves are running out of cash. Their emergency funds are running out. Do you think the money supply will increase or decrease? But this isn't the scariest part. Listen carefully. At this critical moment, the Fed made a decision that appears to be market saving. It stopped QT. QT is basically the process of constantly pulling money out of the market, reducing the money supply. So, stopping QT means they stop reducing the money in the market, right? Sounds a good thing. Yeah, it was supposed to be, but few people know about this. How did the Fed execute QT? It was through asset allocation adjustment. Specifically, the Fed is preparing to replace the over $2 trillion in MBS hold into US Treasuries entirely. What does this mean? Simple. No one is buying the US Treasury right now, so it crashed. To prevent the collapse of the Treasury market, the Fed is selling an asset called MBS, cash out $2 trillion. and using that cash to take over the US Treasury. This means MBS will be dumped into the market in massive quantities. We've talked about MBS in the previous videos. Simply put, when a bank lends you money to buy a house, and you pay them 7% mortgage interest monthly, then the bank bundles that mortgage into a wealth management product called MBS and sold it to investors. This allows the bank to collect the money it lent out and instantly profit from the 2% spread. The Fed has historically been the backholder for these MBS. Every year, they would unconditionally buy hundreds of billions to $1 trillion to take over the real estate debt. To be more directly, after the bank lends money, it's out of cash. The Fed would unconditionally buy the MBS, giving the money back to the bank so it could continue spending. Here comes the problem now. The Fed is planning to stop buying these MBS. This means the Fed will not only stop giving money to banks to spend, but it will also sell the MBS it currently holds, taking back the money it previously gave to the banks and the market. And this amount is substantial, $2 trillion. Faced with the national imperative, the Fed is using this money to protect US Treasury bonds, thereby sacrificing the mortgage market. This is the key. If, in 2026, because of the maturity of mortgage, everybody has to borrow new debt to pay the old, the demand for borrowing will continuously increase, but simultaneously, the supply of mortgage funds decreases because banks are short on cash, and the Fed is dumping MBS. What happens to the interest rate? More and more people are borrowing, but there's less and less money available. Won't the bank have to charge you a higher interest rate? This means the current 6 to 7% interest rate is already 2 times compared to the 2020 pandemic. It's very likely to soar again in 2026. At that point, these trapped landlords can't sell or rent their houses. They can't pay back the money. Even if they could, they can't afford the interest. What will they do? Mass default and refusal to pay will be the only way out. The Fed is cutting rates, indeed, but mortgage rates are rising instead. The Fed is stopping QT indeed, but it's dumping MBS to save the US Treasury, making mortgage funding less and interest rates higher. Conversely, it will be the fuse to ignite the commercial real estate bomb in 2026. This is why Warren Buffett is waiting with astronomical amounts of cash. The Big Short is also waiting. For us, it's the same. If the train of crash is about to hit us, we will definitely exit the market first, protect our principal at all costs. If you have a better understanding, welcome brothers and sisters who have a different opinion. Feel free to leave a comment down below to discuss with us. If there are details in this video that you don't fully understand today, I suggest you watch my previous 2 or 3 videos because the logic is all interlinked. Due to time constraints, I have to end here. But what do you anticipate in the next episode? A lot of people are waiting for this line every week. It's gonna be a crucial one. Alright, I'll continue sharing tips on how to become wealthy, how to be an entrepreneur, an investor, and achieving financial freedom every Sunday at 8:30. If you don't want to miss out, make sure to subscribe to my channel and click the little bell and generously share this video. I sincerely wish all of you who like this video will reach financial freedom soon. As long as you can find 1 or 2 useful sentences in today's content that can help you live a better life, I'll be completely satisfied. Alright, I'll see you next week. Bye.